Gold is surging. Global stock markets are hitting record highs. UBS just raised its gold forecast to nearly $3,900 in the next year. And yet, Ray Dalio, one of the most respected hedge fund managers in the world, is warning that the U.S. is facing a looming financial heart attack caused by runaway debt service costs. This is a story of euphoria colliding with fear. On one side, traders celebrate record markets and bet big on Federal Reserve rate cuts. On the other, analysts whisper about systemic cracks, inflation lurking, central banks losing independence, and gold flashing warnings of distrust in paper money. Today, we go deep into this showdown. Why gold is surging, how debt is spiraling, what the Fed is about to do, and whether we're entering the greatest bull market or standing at the edge of a financial cliff. Why gold is surging again. Gold is having its fourth straight weekly gain, trading above $3,670 per ounce, and UBS projects it could hit $3,800 by year-end 2025 and $3,900 in 2026. But this isn't just about speculation. Gold rallies when trust falters. Three key forces are pushing it higher. 1. Fed rate cuts are coming. Weak U.S. labor data. Just 22,000 jobs created in August. Producer price index easing, signaling inflation is cooling. Investors now betting heavily on a September rate cut, possibly even 50 BPs. Lower rates weaken the dollar, and when the dollar falls, gold shines. 2. Geopolitical instability. Political turmoil in Europe, France's crisis, Italy's debt fears. Leadership instability in Japan, trade tensions between the U.S. and China resurfacing. Each headline sends another wave of money into gold. 3. Central banks buying. Nations from China to Turkey are stockpiling bullion to diversify away from the U.S. dollar. This isn't about trading. It's about preparing for a monetary reset. Gold is no longer a relic. It's becoming the barometer of trust in the system. The Fed's tightrope. The Federal Reserve is at the center of everything. Jerome Powell faces a no-win situation. Cut rates too aggressively, risk reigniting inflation. Stay cautious, risk triggering a recession. Appear politically pressured, risk destroying credibility altogether. The Fed's independence has already been questioned. Treasury officials and politicians are calling for oversight, making markets nervous that Powell is no longer in full control. History shows how dangerous this is. Turkey, politically controlled central banks led to currency collapse. Argentina, interference led to spiraling inflation. 1970s USA, political pressure to keep rates low fueled stagflation. The Fed is walking a razor's edge. The debt bomb. Here's where Ray Dalio's warning comes in. The U.S. government is borrowing at unprecedented levels. Interest payments on the debt have exploded past $1 trillion annually. More than defense, more than Medicare. Dalio calls it a looming financial heart attack. Debt keeps growing. Interest costs eat the budget. Investors demand higher yields. The Fed is forced to monetize the debt, printing money to cover shortfalls. It's a cycle that erodes confidence in the dollar. And history gives us lessons. Rome's fall began with debased currency and unsustainable debts. Weimar Germany collapsed into hyperinflation. 2008 showed how leverage can break the system in days. Today's debt crisis isn't about mortgages, it's about the entire sovereign system. Gold versus paper. Gold's rally is the market's way of saying, we don't trust paper promises. UBS, Goldman, and other banks now openly recommend allocations to gold. Dalio suggests 10-15% of a portfolio. Why? Because unlike stocks, bonds, or even cash, gold can't be printed. It can't default. It doesn't rely on political will. But there are risks. Overheated speculative flows could trigger corrections. If inflation cools faster than expected, gold may consolidate. Crypto is still vying for attention as a digital gold, though its volatility undermines the safe haven story. Still, in every crisis, 1980, 2011, 2020, gold proved its value. Mega mergers and commodities supercycle. Amid the chaos, corporations are betting on the future. The $53 billion Anglo American plus Teck Resources merger is the biggest mining deal in years. Why? Copper. EVs, solar panels, AI data centers all need massive amounts of copper. Supply is tight, demand is soaring. Anglo Teck could dominate the copper trade for decades. This is the other side of the story. While investors hedge with gold, corporations are betting on commodities that fuel the next industrial revolution. Gold equals to defense. Copper equals to offense. Both are winning. The global ripple effect. None of this happens in a vacuum. Asia. Japanese instability weakens the yen, boosting gold demand. Europe. French political turmoil raises euro risk. Emerging markets, countries tied to dollar debt, brace for capital outflows if U.S. rates swing. Global finance is interconnected. A debt crisis in Washington shakes pensions in Frankfurt, banks in Tokyo, and currencies in Brazil. This is why gold is rising globally, not just in U.S. markets. Scenarios ahead. Best case, Fed cuts smoothly. Inflation eases. Gold climbs gradually to $3,900. Stocks rally on cheap money. Worst case, debt spiral accelerates. Inflation reappears. Fed loses credibility. Gold explodes past $5,000. Stocks collapse under stagflation. Both scenarios are plausible. That's why markets are volatile. Lessons from history. 1971 Nixon shock, end of the gold standard, beginning of fiat dominance. 1980 gold spike, inflation panic, oil shocks, and geopolitical risk. 2008 global financial crisis, debt leverage exposed in days. 2020 pandemic stimulus, trillions printed, inflation seeds planted. Each era reminds us debt, politics, and central banks decide the fate of markets. And gold has always been the ultimate witness. Conclusion. A financial shock coming? Markets are euphoric, but gold is fearful. Debt is rising and the Fed is cornered. We may be at the edge of the biggest financial shock since 2008, or the beginning of a historic commodities supercycle. Either way, the message is clear. Stay diversified. Don't ignore safe havens. Watch the Fed like a hawk. This September may define the decade. If this breakdown helped you see the bigger picture, smash that like button, subscribe for urgent analysis, and comment below. Do you believe Ray Dalio's warning of a financial heart attack? Is gold heading for $5,000? Will the Fed cut too much or not enough? And are mega mergers the start of a commodities supercycle? Your thoughts matter, because tomorrow's headlines could make today's story look small. This is Felix. See you next time.